In 1494, a monk in Venice codified double-entry bookkeeping, numbers that forced strangers to trust ledgers more than reputation. Within decades, paper claims and secret scripts shaped fortunes from Florence to the Silk Road. This quiet invention did not just track money, it sparked the global experiment in risk, sharing, and power that would become modern capitalism. But what was really unleashed when trust moved from people to paper? Luca Pacioli, a Franciscan friar and mathematician, published his Summa de Arithmetica in Venice in 1494. Buried in its pages was a method that would quietly transform the world of commerce: double-entry bookkeeping. Pacioli described a system where every credit must have a matching debit, each asset mirrored by a liability, every transaction woven into a self-balancing grid. For Florentine merchants and Medici bankers, this meant that money could be tracked not as scattered piles of coins, but as a living flow. Numbers that always reconciled, no matter how far a branch or partner might be from home. Clerks in Florence began to copy Pacioli's method, filling ledgers with parallel columns for debits and credits. Each entry could be checked, audited, and traced, even years after the fact. This symmetry wasn't just a mathematical trick, it offered something radical for its time: trust in the numbers, independent of the person writing them. A merchant's reputation still mattered, but now a ledger could speak for itself. Transactions could be reviewed by strangers, partnerships could stretch across borders, and investors could believe in paper claims because the books themselves were designed to reveal fraud and error. Bills of exchange, the lifeblood of Renaissance trade, were now tracked with a precision that let bankers in Florence reconcile accounts with agents in Bruges or Venice. The Medici folios show how capital could move invisibly, yet leave a trail that anyone with the right knowledge could follow. Pacioli's double entry wasn't just a tool, it was a promise that, in a world of risk and distance, numbers could be made to tell the truth. Centuries before European bankers tracked credits and debits in ledgers, merchants along the Silk Road and across the Muslim world relied on their own tools for making distant payments and managing risk. In Abbasid-era Baghdad, traders used the suftaja, a written order instructing a distant banker to pay a third party. Unlike a simple IOU, the suftaja allowed a merchant in Cairo to settle debts in Samarkand without moving a single coin, relying on networks of trust and reputation. This instrument traveled with caravans, crossing borders and legal systems, making commerce possible on a scale that would have been impossible with cash alone. Further east, during the Song dynasty, Chinese merchants adopted the jiaozi, a form of paper money and promissory note. Issued by government-licensed shops in Sichuan as early as the 11th century, jiaozi could be redeemed for coin far from their place of origin. This innovation freed traders from the burden of transporting heavy copper cash, letting capital flow more quickly between cities like Chengdu and Kaifeng. The jiaozi's value rested on the promise of redemption, enforced by both official oversight and the reputation of issuing houses. Both the suftaja and jiaozi made it possible for capital to move across vast distances, connecting markets from North Africa to East Asia. These systems depended on written contracts, trusted intermediaries, and shared legal norms, elements that would later appear in European banking, but had already shaped trade for centuries across the Islamic and Chinese worlds. The story of modern capitalism is rooted not just in Florence or Amsterdam, but in these older currents of innovation stretching across continents. On a spring morning in 1602, a crowd pressed into the Oost-Indische Huis in Amsterdam, clutching coins and contracts. The Dutch East India Company's charter had just been signed, and for the first time, anyone with enough guilders could claim a share in voyages to the other side of the world. The subscription ledger opened with names and sums including Dirk van Oos, Jacob Michels, and over 1,000 others, together committing 6.4 million guilders. Some pledged fortunes, others small savings, all entered line by line in thick, handwritten books that would track every owner and every transfer. Ownership was no longer a private affair. Shares could be sold, split, or inherited, but only with a formal entry in the company's ledgers, witnessed by bookkeepers and approved by directors. Yet business rarely waited for paperwork. In the shadow of the Beurs, Amsterdam's new exchange, brokers shouted offers and scribbled notes, trading rights to profits from pepper and porcelain. Prices rose and fell with rumors of returning ships, dividend announcements, or distant disasters. Merchant diaries recorded hundreds of deals, some settled in cash, others by promises to pay the difference if prices shifted. For the first time, ordinary people could buy into a global adventure, their fortunes tied not to a single merchant's risk, but to a company owned by thousands, traded in the open air, and recorded for posterity in the ledgers of the world's first modern market. In 1609, the Bank of Amsterdam opened its doors, offering merchants a new kind of security. For the first time, large deposits could be held and transferred by ledger entry, not by moving bags of coin. The bank's records, kept in meticulous columns, allowed traders to settle debts instantly, even if their partners were across town or across the North Sea. This system gave Amsterdam's markets a foundation of trust, as every transaction left a trace in the bank's books. But stability bred ambition. Soon, the limits of this new order would be tested. Isaac Lemaire, once a director of the Dutch East India Company, became its most vocal critic. After his ousting, he accused the company's leaders of hoarding profits and manipulating share prices. In 1609, Lemaire and a handful of allies began selling VOC shares they did not own, hoping to profit if prices fell. The scheme rattled the market, sending share values tumbling and angering both investors and the company's directors. The dispute spilled into the courts and chambers of government, as Lemaire argued that directors were abusing their power, while the company insisted on protecting its monopoly and the stability of the market. In February 1610, the States General intervened. Their ruling banned the sale of shares not actually owned, a world first. The judgment sided with the company but demanded greater transparency from its directors. The episode exposed both the strength and the limits of early financial regulation. The bank's ledgers and the company's rules could keep money moving, but when fortunes were at stake, the law itself had to evolve to keep pace. In 1694, a group of London merchants and financiers gathered to sign the Charter of the Bank of England, pledging over £1 million to fund William III's war against France. Their names filled the subscription list, each entry a promise backed not by gold, but by trust in the state's word. Coffeehouses along Exchange Alley buzzed with speculation as brokers and directors from the East India Company mingled with government officials. Here, paper promises, banknotes, and government bonds became as valuable as coin. The bank's bullionist policy anchored the new securities in precious metal, yet the real innovation was the creation of a market where state debt could be bought and sold by anyone with enough capital. Thomas Moon, a leading mercantilist, argued that national wealth depended on the careful management of trade and bullion. But in the hands of these investors, liquidity itself became a tool of empire, fueling colonial ventures and military campaigns across continents. The city's appetite for risk found a home in the daily auctions and ledgers, where fortunes rose and fell with every rumor and every shift in policy. South Sea Company shares began in 1720 at £128. By midsummer, they soared above £1,000, driven by rumors, pamphlets, and the promise of easy wealth. London's streets filled with hopeful investors, aristocrats, merchants, shopkeepers, each convinced they could outsmart the market. Among them stood Isaac Newton, whose reputation for reason did not spare him from the frenzy. Newton bought early, sold for a handsome profit, but the mania drew him back in. His ledgers show a final loss of £20,000, erasing years of careful gains. He later confessed that he could calculate the motions of the heavenly bodies, but not the madness of people. By autumn, the company's price collapsed, falling more than 90%. Fortunes vaporized overnight. Parliament responded with the Bubble Act of 1720, banning unchartered joint stock companies and tightening rules on public investment. Meanwhile, South Sea's profits had been built on the trade in enslaved Africans, linking personal ruin to a moral reckoning. The crash exposed not only the dangers of unchecked speculation, but the cost of wealth built on human suffering. Markets still pool trillions, shaping fates far beyond boardrooms. Every click or investment today echoes centuries-old inventions, tools that fuel both innovation and inequality. Capital's rules are not fixed. They are made and remade by us. The future of wealth is still being written. What will we choose next?